Hey everybody, Preston Brent here with our weekly roundup brought to you by our trader user group. This is for the trading week ending November 30, I guess. It's the last day of the month for the trading month of November, which was, as a reminder, even though the vol was a lot higher since we were used to and going into Q4 or in the middle of Q4, like 2017, November did manage to eke out a gain for the entire month. For the S&P, it was up about 2.14%. The Dow was up about 2.15%, but the NASDAQ was flat. Now, I remind you guys, in the month of October, to kick off the Q4 period here in 2018 as we round out the year, October was one of the worst months since 2008. We closed down about 7.2% for the S&P. The Dow was down a little bit less, about 5.4%, but the NASDAQ just got taken to the woodshed. It was down about 9% for the month. So we're starting to see a little bit of a flattening in the markets right now. And this past week was also the best weekly performance as we finished up the month of November. I think that kind of helped November because, in fact, it was one of the best weekly performances in over about 7 years. The S&P was up a whopping 4.85%. Remember, it was down 3.8% in the holiday week here in the U.S. in the short holiday trading Thanksgiving week. The Dow was up 5.16% for the last week of November to help lift the Dow for the month of November. And the holiday trading week of November, it was down 4.4%. NASDAQ was up the biggest of all. It was up 5.64%. And in the holiday trading week of November, it was down 4.3. So this last week really gave a little bit of momentum and energy to the bulls. The VIX was essentially flat going into this weekend because of the upcoming trade meeting between Trump and Xi. We call it Godzilla versus Megalodon. And as it turned out, Godzilla was basically, instead of breathing fire, he was sucking on lollipops and spitting out rainbows, and Megalodon just turned out to be a big old teddy bear. So there was a make nice session, how they loved each other, respected each other. And the net out of that outcome was the U.S. is postponing plans to increase their tariffs on 200, but go from, I think, 10 to 25% on January 1st. So there's still a lot of trade uncertainty. I mean, this will give a feel-good moment for the markets, but this trade uncertainty still leaves a lot of companies uncertain about where to spend money. And really, the only place companies, U.S. corporations, have been spending money in 2018 is in sharebacks and dividends. Unbelievable. In fact, the current spend on share buybacks, the current spend on share buybacks this year has exceeded corporate CapEx, that's capital expenditures, which is what I'm looking for. I want to see corporations spend more on CapEx spending. But it exceeded it in both Q2 and Q3. Share buybacks this year are estimated, we're almost done with the year, of coming in at about 1.2 trillion. I mean, that is huge, folks. I mean, just huge. So the dividends and share buybacks has helped supporting the markets as the Feds are starting to tighten their interest rates. But let's put everything in the context. If we step back for a second, U.S. stocks are up on average over the past 10 years, guys. Now, the past decade, stocks are up on average about 14.5%. Okay, that's about 2 times more than a normalized annualized rate going back over 50 years. So we can't maintain that steam. All right. And meanwhile, the debt market, U.S. bonds are up 9% annually over the past decade, which is 3 times their normal annualized rate. Again, the implications of this, not only for the debt market, but the equity markets, is that going forward, we're going to rationalize, or let me use another word, normalize back to a growth trajectory. It's just like looking at Bollinger Bands. When you get to the upper Bollinger Band, then generally the odds favor it moving back to the center, maybe overshoot a bit and come back down towards the lower Bollinger Band, and then kind of normalize again back towards the center of the Bollinger Band. This is what I'm expecting over the markets over the next 2 years. I know everybody's talking about a recession, or at least the folks, the talking heads on TV. My contrarian indicator has always been Kramer. Whenever he throws a tantrum and is popping Ambien and trying to loosen up, then that's time to go long. And when he's, extremely bullish, then I tend to go a little bit more short. Right now, he was throwing a temper tantrum with the Feds, but he had it right. I mean, same thing with Trump. The Feds were getting a little bit ahead of themselves. The last week in November, one of the reasons why it was so damn strong is Powell helped boost the markets when he gave a speech in New York when he indicated that the current interest rates are just slightly under current neutral rates. Now, I remind you, on early October, he said that we're not even close to neutral interest rates, and that set off the down swing that we had in the month of October. Everybody's trying to blame it on that. I think the markets were just looking for a reason to kind of bring forward PE ratios back into line. Okay, our current PE ratio, speaking of that, of a forward 12-month basis is about 16.3. November of last year, same time ended November, was 21.81. So it accounts for a reduction in valuation of the PE ratio of about 25%, a little over 25%. So that's a good thing. We're getting valuations a little bit more in alignment. I think they're elevated still a little bit. Keep in mind, for the past decade, we've had central banks from South Korea, Japan, China via the PBOC, the US, the Feds, the ECB across the 19 countries that make up the ECB, and then Great Britain, all in heavy, even other Asian American markets, Latin American markets, central banks just throwing a lot of liquidity out of the markets. Now, the implication of that was we had a little bit of a pretty good little rise in the asset class. It really extended. As I said, stocks up here in the U.S. 14.5% over the past decade on an annualized basis, guys. 2.5 times more than where they should be. So what we're going to see is central banks, and that was the implication of all that easy money. Now, when they start to reduce the balance sheets, which the Feds are doing at the rate of about 40 to 50 billion a month right now, we cannot not have an effect to the markets. It's impossible. You just can't affect the markets or not affect the markets. The Feds are going to try and go for a soft landing, but I just think over time it's going to be very difficult for them to do. That does tend to mean, though, that we're going to see a little bit more volatility on a go-forward basis, because when there's so much money in the markets, there's no place for the money to go. It goes into the equity markets. So the volatility, like 2017 was a great example. I don't think we had more than 5 days with the S&P moving more than 1% up or down. It was crazy. And we had like 5 days in the first 3 weeks of January where the markets were running. And then almost every other day in the month of February of 2018, we had a more than a 1% move. So volatility is going to be with us for a while. Now, there are a number of things on my radar screen that I'm watching. I'll go into it with our members this Sunday night. On the passing of George Bush Sr. in the United States, Trump has declared a National Day of Mourning on Wednesday, so that means the markets will be closed. The futures market, I'm going to watch them. I haven't gotten the detail on when they're going to open, but it's probably going to be like most holidays. They'll be open in the evening and probably run a half day and then shut down. But Wednesday is going to be a down day for the markets. So for our members, we will have our evening session tonight, Sunday, and then our Wednesday morning session. It's going to be a day off for the market, so we'll stand down. Although our daily chat room will be running, especially if the futures market is running. But I'll go into some of the other things that I'm watching here, especially the triple Bs, the lowest grade investment grade bonds. We want to look at that credit spread between the investment grade and junk bonds. Got to watch it. It's widened just a little bit, but not too much. I'm not too concerned about it right now. So let's get into the charts. What you see on the screen here is the E-mini S&P 500 futures, a daily chart. Now, let's go out to a weekly here for just 1 second, and let's just zoom it out so that you can see here. Now, as I move this thing out, you can see the 2018 open, 2018 low, 2018 high. You see these lines going left to right across the screen. These are what I call market maps. It's a good tool that I use that basically plots volume over price. But what it does is it goes back, and this look back period I've defined is 90 bars. So in this case, this would be 90 weeks on a weekly chart or 90 days on a daily chart, which is a little bit more than a quarter. And you can see here that for the longest period of time, coming all the way back to early summer of 2014, we really maintained a steady run here. And then in 2016, right in this area here when we had the presidential elections, all of a sudden the markets just went crazy. I mean, they shot up big time. Okay, so the presidential election was right at this period here. You can see the volume over price. This yellow line represents the value area, or where the most volume occurs on a price, relative price basis. So that tends to show where all the buyers and sellers are pretty much in equilibrium, okay, which is where markets tend to stall out, okay. Not enough buyers to push it higher, not enough sellers to push it lower. And then all of a sudden, when Trump was elected, we established a whole new equilibrium set right up in this area here. And it only took us about 6 to 8 months to get up here. Okay, so I'm going to focus on this set right here because I do not see us coming back down into this area down here anytime in the near term. Okay, I just don't see that happening. So let me just zoom in a little bit and let's focus on this near term set here. Let me just get all this drawing off the screen here and we'll zoom in. Still on a weekly chart though. Now you can see here on this weekly chart, again, as I said, the yellow line represents where a lot of buyers and sellers came in. The most came in and where price was pretty much in equilibrium, right around the 2400 level. And this was back in 2017, summer of 2017, as we were coming into the end of 2017. And now there's another level right in this area right here, which kind of puts us out right around the 2018 open price of 2675. Okay. And then you will see this green bar here, which tends to be a resistance zone, is where limited volume takes place. It's kind of like a black hole in space where prices have a hard time pushing through. It takes a lot of energy or gravity to move it through. And that puts us right around the 28, if I had to come out with it exactly, right around the 2840 area, which is just slightly above some key pivot points here in the E-minis. So I would expect a lot of resistance up in this level right here. Now, if I come in and let's zoom in a little bit tighter here just to show you what I'm looking at as we go through the end of this year. Let me put it on a daily and then we'll get the same view of the market map over a daily basis. Now, as this paints on my screen here, you can see I've got multiple yellow lines. So that just shows that the markets have been in, there is a really big fight for control here between the bulls and the bears. There is one sitting right at this level here, almost where we are, right in this area here. There's an equilibrium point, which is around the 2735 area. So that is one area. Right up in this area here, which also happens to be where we had that double top with these prior pivot highs around this was the one that I pointed out on the weekly, right around 2835, 2830 area. There's going to be huge resistance there. And then there's another one right up in this area here around 2885. So these are going to be the really hard areas to punch through. Now, layered on top of that, we get this congruency here with some key indicators. So and what I was showing our members is if I just blow this up, and let's just kind of zoom in a little bit. I mean, this is amazing to me. This is an EMA chart, so the 200 and the 50 EMA are a little bit more sensitive to movement. But as you can see here on this daily chart, look at the 50 EMA. I thought for sure where we were down here and the 50 EMA was literally pointing down at the bottom down here, that the 50 EMA would cross below, would have that death cross. But they both flatten. They're almost right on top of each other. And notice we closed the futures market right on top of both the 200 and the 50 EMA. Now, with the news coming out of the G20 meeting with Trump and Xi, Godzilla and Megalodon, and it's coming out to where we're going to postpone the tariffs, I think that's going to get a little bit of an uplift to the markets, and I think we're going to continue our march higher. Notice here, as I show you here in this zoomed version on this daily chart here, going back to November 23rd, that last week in November, the momentum is going to carry us into really the first full week of December. You can see we've made higher highs and higher lows, right? So if you look at this, we started off right here. There's a higher low. As I move up, we've been making higher lows every day. every day we've started out making higher highs, right? As I circle the top of each bar right there. So we're making higher highs and higher lows. And we've done that consecutively for 1, 2, 3, 4, 5 bars. All right. 5 bars, we've made higher highs, higher lows. So momentum is really carrying us. Now, the question everybody wants to know is this just a dead cat bounce and we're going to roll lower? Or are we going to have a little bit more of a rally? I believe with the news that came out of the markets, I think the markets were front running this. I think everybody was kind of in tune with what Trump was doing and saying he was talking very tough. But the minute he got down there, his tune and his tone changed to him and Xi being best friends, good old buddies. And whatever reason it worked out. So I think the momentum is going to carry into next week, especially it's going to be a short trading week for the U.S. with the National Day of Mourning for President Bush Sr. on Wednesday. So you're going to see the markets run higher. Now, where do I think we can go to? I do believe that the next area that we're going to probably go into and challenge is this next volume over price, sitting right at that area there, right around 28.20. Okay, you can see that yellow line, which also happens to be where the prior pivot highs are. So I do believe we're going to work our way up into this area here. And depending on the gap that we get on Monday and maybe follow through action on Tuesday before we go into the holiday on Wednesday here in the U.S. or the day of mourning, I guess. Not really a holiday, a day off for the markets. We're going to see us probably coming close to challenging this area. Would not be surprised to see us hit 2,800 by, if not Monday, by Tuesday, really quick. The option market is pricing in for just one day, for Monday, a plus or minus 68 standard deviation move of about 47 points. Okay. So that means that we can move up or down 47 points. In this case, it's probably going to be up. And if you add 47 points to the 2758, which is where we closed, that puts us right at a little over 2,800. All right. Coming into Monday's close. All right. So that is what I'm looking at. Now, what does this portend for the month of December? I have been of the opinion that we're going to have a December rally. I believe that is kind of written into the cards. The rally actually started in November, the last week in November after the Thanksgiving week was really rough. And then the last week of November going into the early December, very strong week. As I said, it was one of the strongest weeks that we've had in 7 years. I think that momentum is going to carry through. We will eventually move our way up as we go through the December month. However, on the downside, I will call everybody's attention. I do not see us getting up north of 2,900 by December. I may be wrong. I hate making predictions like that because I generally follow price action. But we've got a number of headwinds we've got to get through. This 2820 area right here first, and then back up to this 2875 to 2900 area second. I think it's setting us up for a pretty good little pullback in January and going into February. As I remind you, January will be Q4 earnings, and analysts are already cutting back their earnings guideline. In fact, they've cut their Q4 earnings estimates for S&P companies by 2.5%. All right, that's the largest reduction or decline in their estimated earnings since 2017, since Q1 of 2017. So, and then what they're also saying, analysts are saying for the full year, they're cutting their growth to just 3.9% for the year for earnings per share. Okay, that's after a very strong 2 and 3, very strong earnings growth that we've seen, especially for Q2 and Q3. So that's going to put some downward pressure on the markets. It's not enough to move us into a recession, but it is enough to give us a little bit of a pullback. So I can see that hitting the markets here. If we look at NASDAQ, which has really been on a tear, you can see here as I wait for this to paint on my screen, We're going to get the same follow through here with NASDAQ. You can see this volume over price right here at about 6,900. We're sitting just north of that. We're going to run up towards these pivot points right here, probably around 7,400. I can see us getting there through the end of the year. And then if we look at the Dow, which has been relatively strong, you can see here we're sitting. It's really the only one that's really moved above its 50 and 200 EMA with strength. And I think it's going to come up here and really continue to move higher. You can see there's an overhead resistance zone up here around 25,875. But I think the momentum is going to continue to carry us up. If we look at volatility, if we look at the VIX, you can see we're still in the yellow zone here. It's going to come down. The volatility has been up a lot, knowing that Trump and Xi were going to meet on Saturday. And the market makers maintain that volatility. That's why the VIX, or the standard deviation move for a one-day event for the month, for the day of Monday, was over 47 points for the S&P. I mean, that's huge for the SPX. Huge for one day. It's almost like an earnings event. But I think we're going to see Monday a lot of volatility get sucked back out of the market. We'll see the VIX come in out of the yellow zone, back into the green zone again. The front month vol futures, if we look at that, this is the difference between VIX and the front month vol, which is now December. We're still in a backwardation state. We've kind of worked our way off of that since the middle of October, and we've kind of slowly worked our way back down again, but I think we're going to move into a normalized contango structure here on the front month term structure. Okay. And then if we look at the back month term structure of volatility, you'll see we're already in the green here. So we're in a contango in the DECE January term structure. This right here is what drives pricing of the ETF VXX, for those of you that follow it. For our members, we've been making some nice plays on VXX. We'll continue to do it. And this gives us a clue as to the roll yield in VXX on a daily basis. So we're in a normalized contango structure on the back month term structure, on the front month term structure. Again, we're just barely in the red, but I suspect this is going to move back into the green, which will give us lower VIX and just kind of take the skews back into a normalized environment. If we look at bonds doesn't know what to do. You can see here with bonds, looking at the market map, you can see we're sitting right at a value area here, right around the 120, right around the 139.28, and that's kind of almost exactly where we're sitting. You can see there's another value area slightly lower at 138. And if I move up, there is some resistance up here around the 141 area. I think bonds, interest rates really got a little bit ahead of themselves when Powell in early October said what he said. So I think interest rates, while they're going to kind of loosen up a little bit, maybe come in just a little bit, they're not going to come in too much. All right. Keep in mind, we got a Fed scheduled rate hike that's all but priced into the markets on December 19th at 25 basis points. The markets want to see what Powell is going to say. So that'll keep the bond market guessing just a little bit going into that meeting. I don't see the bonds moving up or down too much prior to that meeting. Okay. And keep in mind that the CPI data and the PCE data, the PACE data, is going to be followed very closely as for clues as to inflation or no inflation for what Powell is going to do, especially now that he came out and said they're just slightly under the neutral rate. Everybody wants to know what that neutral rate is. So we'll follow this pretty closely. If we look at the dollar is, busting a move up around 2018 highs up here. You can see the value area of the dollar is a little bit lower. I think the dollar is going to come in just a little bit. You can see these multiple market maps, which map out the volume and price, going all the way back to the on this daily chart, going back to Q4 of 2017, right? And you can see how the dollar's just moved up very strongly, and then form these value areas before buyers come back in and form a new value area. I think a little bit of a pullback in the dollar is probably in order here. Meanwhile, the euro, just the opposite. You can see here where we're down here around the 2018 lows. So it's forming a low down here. I don't see a lot of movement in the euro much higher, just like I don't see a lot of movement in the dollar much lower. I think they're going to kind of hold up here until they get more clarity from the Fed. Okay. The British pound we're watching very closely. I like this one to the upside, just not yet. If I were to just kind of get this back in alignment here, you can see the value areas here and the market map on the British pound as we kind of step out in price here. You can see just the huge move lower here and these multiple market maps where the value is defined. There is a ton of overhead resistance running from about 131 to 134. And we're down here in the lower zone. So the only thing that's going to get the pound much lower is just more bad news from a Brexit standpoint. It tends to be a headline-driven event right now. I have been saying I want it to go lower. I'm ready to go long, just not yet. I need to see some more proof. Right now, it's showing more of a downside action than anything else. Oil, energy. This is one where some of our members made a killing. $20,000 to $30,000 in a very short period of time. If you'll look at this chart on a daily basis, for those of you that follow us in our weekly setup here, when oil was up in this area here, I was calling for oil to come back to the low 60s, and it overshot. I was calling for oil to come back down around 62.50 area, but it overshot the upsloping trend line and just kept coming right on down. We got these purple bars down here, which shows exhaustion. So we're near that exhaustion point. We got OPEC meeting on D6. I think they'll do a production cut. The market's looking for a 1 million barrel a day production cut. But you can just see how really decimated this is. If I put it on a weekly chart, I think you'll get a better view of just where price action is coming to. You can see this yellow line right here, which represents volume over price going back to the Q1 of 2017 all the way up to today's date. This is where a lot of buyers and sellers were pretty much in equilibrium, around 48.38. And notice I put a little shaded zone there, so that's kind of where I believe we're going to go to, or at least this is going to hold us up. So I would be more interested in looking at long positions, neutral to long in oil rather than short. Doesn't mean we can't come down a little bit lower. Again, we closed at 50.72. We actually moved into the low. We were down at 49.41 during the week. And the value area is at 48.58. So we were off by about $1, okay? Going back over a year, just over $1 in a value area here. So I could see this finding some support. And then for our members, we'll look at some ways to play this. As you guys will remember, for some of our members, I was calling shorts here, and they bellied up to the bar, and we took the trade. It was about a $25,000 win on a per contract basis. It was great. If we look at it, let me just bounce out so you can see this trend line here that we broke. This trend line actually started in the summer of 2016. And we had multiple tests here. You can see the value areas here as we've moved up. So now we're going to find ourselves, the guy that created this calls this alligator jaws, which basically means we got a value area sitting right there, and we got a value area sitting right there. So that means this area right here is probably going to be eventually where we settle in. That would be around $68 a barrel and $48 a barrel. So that's about $20 a barrel, probably because we've had such high volatility in the market. I think it's going to kind of move like a Bollinger Band, kind of back up into this area right here to come up with that resistance point right there, which was a support point right in that area there, around 55 a barrel. So there's going to be some great trades in the oil market. This directional trade, we were long gamma, short delta, and that trade turned out to be a really good home run trade. Now, another trade that we follow really quite actively is the spread between Brent and WTI. You can see this spread is off of the highs here that it made in the summer this summer here. And it looks like it wants to come back into this support area here around 687. If I put it on a daily, it'll show up a little bit better for you guys. You can see here there's a value area right here that we broke. We're right at this support area. Remember what I said about the green bars? That's where the least amount of volume occurs for this time frame that we're looking at that goes back to July of 2018. So there's not, if we break this, then generally what we will do is run down to the next pivot high, which is right around the 659 area. So what we do is you can see it's trying to move back into this pivot zone range here. And the way you play this is you short Brent and you go long WTI. Okay. We took this trade over here. It was a really great trade for us, $1,000 a point up in this area, and it just came unglued. This was the coming Iranian sanction battle with Trump. That's what really drove this one like that. And now that once we get out of OPEC, we'll get a direction of where the spread wants to go, and we'll see how we want to make a play in this. The other one that we're playing with is nat gas. Nat gas has gone like a bat out of hell. Look at this. This is a daily chart. In fact, let me put on a weekly here. That just shows you the extreme of the move. You can see on this weekly chart here, and I look at these value areas and look at these market maps. This goes, folks, all the way back to 2013. You can see here the value area going back to 2013. Here's an area here. I extend it out. Here's an area here. And here's an area here. We're like, this is the value area going back 5 years. Folks, we're going to be back down in this area again, all right? We're up in an area where very little volume has taken place. And when it gets up here, it just cannot hold it. I think nat gas is going to come back down here again, but we got to give it time. You can see these exhaustion bars, they're purple. That tells me that we're in an exhaustion mode right now, and the odds favor a pullback. Now, that does not mean that if you come in short here, that you may not get punished with some higher moves. You know, the odds, it's kind of like the opposite of catching a falling knife, because the nat gas market is one of the most volatile futures markets you can trade. It really is volatile. But so you want to try and do it as a defined trade, not as, short calls or short puts. That's what put a company out of business 2 weeks ago with the big movement in nat gas. You guys may have seen the suicide video on YouTube when this company almost went out of business. I felt bad for them. Good people, but they just they took for granted the markets were always going to do what the markets never do, which make these unheard of moves here. So again, coming back to the daily chart, we're going to come back in alignment again on the nat gas market. For our members, we'll review our trade, but it's a great way to make this play back down into this area again. So that's the energy market. Metals, gold, as I've told you guys again and again and again, I'm not ready to go gold yet. You can see the value areas down here on this market map. If I were to blow them up, you can see this yellow line right here. We're just slightly, we're almost right on this value area, sitting around 1223. Okay. We're above the 50 EMA. We're below the 200 EMA. They're coming together. The 50 EMA's got a slightly upward vector. The 200 EMA's got a downward vector. So we're going to be in this kind of crunch mode right here. When the markets are ready to roll over is when we're going to be ready to shift some of our bias here on gold. I'm not ready to do that just yet. All right, we've got some other activity going on in the ag market, especially with the Chinese Godzilla Megalodon truce. China's already made a commitment that in addition to this stuff, China has made a commitment to buy a substantial, and that was the word used in the press release, amount of U.S. ag, industrial, and energy goods. So we're going to get a bump in some of these markets here. So be careful on chasing these things, guys. But I do believe we're going to get some really interesting movement in the ag market.
and pretty much all markets as we go to open Sunday night futures. All right, everybody, members, I will see you tonight in our weekly market watch. If you're not a member, I'd highly encourage you to come on in and take advantage of it. We're knocking the ball out of the park on some of these displaced commodities. I see some really interesting times coming up in 2019. Um, for our option masters next Thursday evening, we're going to talk a little bit more about the debt market because I think a lot of people don't really understand it very well. Otherwise, everybody, I will see members. I'll see you tonight, 8 p.m. Eastern Standard Time. Non-members, have a really great weekend. Hope to see you on the inside sometime soon. Take care, everybody. Ciao.